Streets 993, your choice of hip hop and R&B. C-Dub is up in here, man. And on the show today, I got my man Marcus, who is back here with Johnson Capital Planning, who's giving us some information, some financial information, some financial literacy to help get you to the next level. Marcus, thank you for being on the show again today, bro.
Man, appreciate you for having me, man.
Man, that's what's that. So, quick rundown. Quick bio, who you are for those who are listening and watching, don't know who you are, which they should have by now. But anyway, tell them a bit about you, bro.
Yeah, again, my name is Marcus Johnson. From here right in Nashville, Tennessee, North Nashville to be exact. Yes, sir. Yes, sir. Graduate of the Tennessee State University with a degree in economics and finance. Was able to parlay that into a job on Wall Street. Worked there for several years and then decided I wanted to become an advisor. And I started my firm, and here we are.
That's what's up, man. Thank you for being on the show. Some of you guys don't know, you might want to check up the other episodes where we talked about budgeting basics. We also been talking about financial planning for families, for my people who are out there who got kids and families and stuff like that. And on the show today, we want to talk about investing, the basics of investing. Some of you guys are not doing it. Some of you guys might think about doing it. Some of you guys want to do it, but don't even know where to start. All right. Yeah. So on the show today, we're going to talk about the basics, how to just get the ball rolling in investing for your future. All right. So what's the simplest way to get started, Marcus?
I mean, so now they make it so easy for people to start as a beginner, right? So there's so many apps that you can just download right on your phone, right?
Like Robinhood and stuff like that.
To Acorn, to E-Trade, right? All of those are going to be good platforms that you can just start, easy, start investing, especially because now they let you, do what they call fractional shares, meaning that you don't have to buy a whole share of stock. So they make it easy. You can do as small as $5, $10, right? And
really?
Yeah, because you can buy fractional shares, right? And so basically what that means is I can go into the app, I can deposit $10 and then buy any stock I want because I can buy a fraction of a share, right? And so the apps allow you to do that, right? And so, super simple. The next question I always get when, after we get past that part is what should I start investing in, right? Again, always consult with your advisor before picking any stocks, right? But I just tell people to just think about the stuff that's in your household, right? What are you consuming and purchasing on a regular day basis? Buy that.
Toothpaste, toilet paper.
Yeah, right. Okay. So who owns that stuff, right? Probably Procter and Gamble, right? So why not buy some shares in Procter and Gamble? Or, right, the phone that you're on is Apple. Just make it easy, right? You know what I'm saying? These
not
things,
too hard, man.
Right?
It's not too hard.
Whatever the stuff that you're already using and utilizing, right? If you're a big sneakerhead, maybe look at getting some stock in Nike, right? And so, these are things that are just right in front of us. These companies aren't going anywhere, so just start there.
Okay, man, that's good to know. How can you determine your risk tolerance and choose the appropriate investment?
Yeah, that's great. And so risk really comes down to what you're comfortable, right? So never invest any money that you're not comfortable losing. Period.
Say that again.
Never invest any amount of money that you're not comfortable with either losing or seeing fluctuations in your money. So, right, because it's called an investment.
Yeah.
Right? Everything is not going to be a win. Right? Yeah. And so just understanding that when we start talking about investing, you are taking on risk.
Even in the apps.
Even in these apps, the money's going to go up and down, right? But let's talk about, what is really happening when we buy securities, right? Or stock. So basically what happens is that I buy a stock, right? So let's take it back just a little bit. And I know these wasn't on the questions, but I have to tell people this real quickly, right? So really, let's talk about how do we make money off these stocks, right? So
that's the main thing.
Exactly, right? You can talk about what companies and all that type of stuff, but let's get an understanding of how we actually make money off stock. So it's two ways that we make money off stocks.
Okay.
First way is called capital appreciation. So basically that means let's just take, any company, and again, I don't have this information right in front of me, so I'm just bringing out numbers, right? So don't go on here, the stock price is not what he said, right? I don't have it in front of me right now, right? So let's just take AT&T, right? I'm just picking on AT&T.
Yeah.
Right? I'm not telling you to go buy AT&T. I'm just picking on them right now. All
right.
So let's say that they're priced at, $20 a share. So that means it's going to cost me $20 to buy one share of AT&T stock, right? Now, how do I make money? I make money if that price of 20 goes up, right?
So what makes it go up?
So what makes it go up is a great question. Demand. right? So the more demand you have for a stock, it's going to push the price up. Well, just with anything else, right? Supply and demand. So if everybody is buying those J's, what they going to do to the price? They're going to push it up.
Push it up.
Right? And if nobody is buying it, guess what's going to happen? It's going to go down. Right? So that's what's happening in the markets, right? You got supply and demand, right? The more demand you have a stock, it's going to push it up. We could go in and have this conversation about what happened during the pandemic with the AMC and GameStop and all that stuff, right? You had a lot of money being pushed into those stocks, which was making the stocks go up, right? So I got $20, it goes to $25. Right? Now, the question then becomes, did I make money? Right? So if it goes from 20 to 25, on paper, it looks like I made money, right? But the only true way that we make money off it going up is if I sell it. So if I have it at $20 a share and it goes to 25 and I do nothing, it's just a paper gain. But if I have it at 20 and it goes to 25 and I sell it, now I actually have locked in those gains, right? So why do I bring that up? Because it works the exact same way in reverse. So if I bought the stock at 20 and it goes down to 15, did I lose?
Yeah.
Well, we just say the only way I can make money or lose money in the stock market is if I actually sell. So if I bought it at
still
20,
holding on to it.
So if I bought it at 20 and it goes to 15, I haven't lost anything. It's on paper. The only way I lose is if I sell it for a lower price.
It's a lower price than what you bought it for.
There you go. But I have to actually sell it.
But if it's just sitting there.
Right? But we know over time, the markets go up. Right? All the historical data is there. Right? All the actuary science is there. We can literally have information that we can go out to look at what has the markets done historically. Right? But generally what happens is people's emotions make them make these decisions when it comes to losing money in the market. That's the piece that we don't talk about.
Oh, okay.
Right? So that's one, right? So I make money, it's called capital appreciation, right? I buy a stock at one price and I sell it at another. Yeah. Now I have what they call a capital gain.
Right.
Understand. Anytime I sell a stock, I'm going to have some type of taxable, it's going to be taxed at some type of rate, right? Whether it's going to be, especially in these type of accounts, right? Now, if we're going into, Roth IRAs and stuff like that, then we can have a different conversation. But I'm only talking about these brokerage accounts that you're going to open up at, Cash App or Robinhood or whatever, right? So if I hold a stock for at least 12 months, then I'm going to have what they call long-term capital gain tax. Right. So I have to pay taxes on this money. Right. So we got to make sure that we telling people that we can't just be doing this stuff and I don't pay taxes.
And not pay no taxes.
Right.
You can if you want to.
Nah, listen,
they gonna come looking for you.
I ain't got nothing to do with that. It's between you and my good friends at the IRS.
Them alphabet boys.
Right. So that's one. And then number two is if I hold the stock for less than 12 months, now I get hit with short-term capital gain tax. And it's always going to be higher. Right. So generally I tell people that we want to at least hold stocks for at least 12 months because we're going to pay less taxes. Right. So if we start doing with the, traders and all that type of stuff, now you're going to be getting hit with short-term capital gain tax. Always consult with your CPA before making any of these decisions. Right. But hold your stocks for more than 12 months. That's the whole record on that. Right. Now, so first way, capital appreciation. Right. Second way is called a dividend. And most people have heard of dividends. Oh, let's take a dividend and we're going to be able to, I hear all kind of crazy stuff. I'm going to take the money from my stock paying dividend. I'm going to pay my bills with that. Right? I'm like, what are you doing? Right? You kind of missing the point here. Right? So what a dividend is a cash payment to that investor for investing into said stock. Right? So let's just say AT&T right now is paying a 6% dividend. So let's put this in real world. So if I had $10,000, I invest into AT&T, it's going to pay me 6% dividend. Right? So that means they're going to pay me $600 a year just for investing in AT&T. Right now, it's crazy for you to take that $600 and just take it out as cash, right? Because number one, you got to pay taxes on it, right? But what we should be thinking about is taking that $600
and go buying some more,
reinvesting it back into your portfolio,
buying some more stock, right?
Right, because that's called compound interest.
Okay.
Right, compound interest, like Warren Buffett says, is the eighth wonder of the world. Right, that is where real wealth is created because now we're compounding our money. So think about it like this: I got $10,000 year one, right? Then I get a dividend for $600. Right? From that 6%. So now my balance is 10,600. And of course, this isn't a perfect world. There's going to be a lot more factors going in here.
Yeah.
But now, the next year, I'm starting with 10,600. Now I'm getting 6% on 10,600. Compound interest. Because every year, we got more money.
In there.
Right?
Yeah.
And so that's how we're starting to make money off the stock market. Make sense?
Mm-hmm.
So 2 ways. Capital appreciation, meaning I bought a stock at one price and I sell it at another.
Yeah.
And dividend, meaning that that company is going to pay me some type of percentage. Right now, all companies don't do that. Some companies believe that why would I give you a dividend when I could take that money and reinvest it back in our company, which is going to help boost the stock price, right? So they call those growth stocks, right? Some of those growth stocks don't actually do that. So, depending on, what type of stocks you invest in, would depend on, if they pay dividends or not. But I just want to make sure and be clear that all stocks don't pay dividends.
So let me ask you, what about how long do you think the dividend needs to stay circulating?
I tell people in my practice that if we are getting dividends from a stock because we're, when we're investing in companies that pay dividends, we're keeping that money in that portfolio until we actually need the money.
Smart move.
Right. So we want to reinvest. We want to rebalance, right? Those are words you'll start to hear, right? Our portfolio so that we're actually making that money continuously work for us, right? So when do we sell a stock? When we need the money.
Right.
Right. But that's why when we talked about in other episodes, let's make sure we got 3 to 6 months of savings, liquid. Mm-hmm. So the money that we're investing over here, we're not touching that.
You're not
right?
affecting. Yeah.
Right. That's why I tell people you want to have multi-layered buckets of where you're putting your money. Right. I got money where I can go get it now if an emergency happens. Right. I got money that we're investing for, retirement. And I got money that we might be, putting aside for all the other things that we might want in life. Business, maybe you want to pay for your kids' college, mm-hmm. wedding, et cetera, et cetera.
Now, what would you say to somebody who feels like all their money that they're making, they're paying bills, they don't see anything extra mm-hmm. for investing?
Yeah. So I would tell you that, the first thing that you're going to have to look at is go back to your budget and figure out where your money is going. Right. Mm-hmm. Because if we're living in this rat race where every time I get paid, all the money's going out, we're going to have to start cutting. Right.
Yeah. Cut some.
So, okay. A lot of times people make, the overall financial planning a lot more complicated than what it has to be. Right. Because there's really only 2 things you can do. Either we're going to make more money or we're going to cut expenses. Yep. Right. Or a combination of both. I know we talked about it previously, but, I see a lot of times where people are spending, extra money on multiple apps that do the same thing, right? So you don't need Spotify, Apple Music, and Tidal. Pick one. They all play music, right?
Right.
I had a chart, I don't have it in front of me, that showed if you was paying for all 3 of those, how much money you could have saved over a 30-year period, right? Oh my goodness. And the number was staggering.
I know, it was crazy.
It was crazy, right? But a lot of times people, they are overspending in that area, or they're overspending in the convenience factor, right? DoorDash, Uber Eats, Grubhub, right? So if I'm already living, paycheck to paycheck, why am I giving myself these conveniences, right? I'm overspending, right, in areas that we can start to kind of cut down in, right? So, and the other thing is that we can find in our budget to take a percentage of your money to start allocating. It could be small, right? But it starts with that habit. So if I'm literally, all right, I'm making 50,000 and I'm struggling, we can find 10, 15 bucks somewhere, mm-hmm. right? Start putting aside, right? Sometimes people will tell you 10%. I hate getting into percentages when it comes to that when we haven't started the habit. Let's just start somewhere, right? Start small. Right. And it'll start to add up over time. Right. And now you'll get more comfortable. Right. So maybe it's, I'm going to start with $20 a month. Let's start there. Right.
Be some realistic goals.
Yeah. Realistic. Right. That's $5 a week. Right. All right. So, $5. We spending that somewhere.
Yeah.
So instead of going to Starbucks or,
stopping at the convenience store.
At the convenience store.
And, yeah.
Right. I'm going to start with $20. Some people are like, that ain't going to do nothing. Right. No, what it is doing is creating a habit.
Yep. The mindset.
Mindset, because now you'll start to see, all right, oh man, this $20. Now I got, $120 in here, right? Now this in turn to $1,000, right? And so now you'll start to see and you get comfortable with it, right? And then as it gets easier for you, let's do more, right? And so yeah.
What would you say the difference between mutual funds, EFTs, and individual stocks?
Yep. So great question, right? So let's take it in the reverse order. Right?
Okay.
I think that's a better way to explain, right? So an individual stock is one, right? So that could just be like AT&T that we talked about, right? So we're investing our money into this one company, which is AT&T. Okay. Now, mutual fund, right? So mutual fund is nothing more than a pool of stocks. So instead of just having one, now we have a pool of them, right? So this could be Apple, Microsoft, Nike, etc., all pooled together with a money manager that's going to charge you a fee, right? So mutual funds, in my opinion, are kind of becoming outdated because they're expensive, right? So now we have ETFs, right, which stands for exchange traded funds, and so those are basically what it is. What it does is it's a fund that tracks some type of index. So it could be the S&P 500, right? So now we can buy an S&P 500 ETF. What basically what it's going to do is going to track exactly what that index does, and it's not going to be as expensive as those mutual funds, right? So now a lot of people are moving from the mutual fund model to getting the ETFs and the individual stocks.
That's good to know, man. Any information what is something you want to tell somebody who's listening and watching right now, who want to get off into investing?
Yeah.
But they still just like, I don't know, I don't trust it.
Yeah. Well, a couple things, right? We talk about the wealth gap in our community, and we start having those deep conversations. I tell people, look, we don't have the luxury anymore of sitting on the sidelines. We got to go where the money is being made, right? And so part of that is making sure that our money is working for us in the capital markets, right? Which would be the stock market, right? And so it really comes down to, I want everybody to be comfortable with what they do, but still have the notion that we need to start taking some of our capital, even if it's a small percentage, to start investing into the market, right? Whether that's, like I said, that $20 a month, or, if that's too low for you, start with $100, right? Start with something that you're comfortable with, right? But again, understand that there's always going to be risk involved, and the markets are going to go up and down based on what's going on in the economy, right? That's just part of it. That's what it does, right? But we just need to understand that for a long haul, we need to make sure that money is working. And then here's the biggest piece that I want to make sure. Investing is not a short-term thing, right? So a lot of times, and I like to relate things back to sports, right? So it's always funny to me when a client comes into the office, we invest their money into the market, and it may be 1 or 2 months, and they're looking at their account value because based on what's going on in the economy, the markets are down for when they came in. And they're calling me like, oh my God, the markets are down and da-da-da-da-da.
Right.
So I was like, you watch basketball? Yep. Or maybe they say, nope. Would you watch football? Yeah, I absolutely watch football. All right, well, just think about it like this. Who's your favorite team? Who's your favorite team?
Titans.
All right, so we're gonna go with the Titans. All right. Well, this is a great example for them. Right? And so that's like saying that in the first quarter that we're losing, that we're just gonna go ahead and just quit the rest of the game.
Yeah, that's crazy.
Right? So you're talking about 3 months of being in the market, and you're already worried about what the market is doing. It's only been 3 months.
Yeah, that's one of them you gotta set it, leave it, and
this is come back. Right? Your time horizon should be 5 year, 10 year, 15 year. Right? Warren Buffett says it all the time, and if you don't know who Warren Buffett is, then you need to go look up who he is. Right? Like if we can't hold a stock for a long period of time, then we don't need to be investing. Right? So the whole premise behind that is hey, if we're gonna put our money in the markets, we need to understand that we're having this money work for us for a period of time, whether that's 5, 10, 15, 20 years. Right? We need to make sure that we go into that with that mindset.
That's what's up, man. Hey, before we get up out of here, how does somebody choose the right brokerage?
So at this point, they're all pretty much very similar, right? I'm not gonna say that one is better than the other, because they're all at this point, acceptable, right? Especially when you're talking about what I deem as smaller amounts of money that we're going to be starting with, right? So all of them can work, right? And so a brokerage account is literally just an account, right? So that's not doing anything for you. So that's just like going and opening up a bank account at Regions or Bank of America, et cetera, right? Those are just accounts. It's the actual investments inside the brokerage account that actually makes them perform. Same thing with if we was talking about retirement accounts, right? So you got traditional, you got Roth IRA, et cetera, et cetera. So sometimes people come into my office and they're like, well, what are your Roth IRAs paying me? That lets me know that we don't have a true understanding of how this stuff works, because the Roth IRA or the traditional IRA is just an account, right? It's the actual investments inside of those vehicles that makes it go. So if you're asking me what it's paying, well, it depends on what are we investing in, right? And that depends on your risk strategy. It depends on, what's important to you. It depends on, right? Because at the end of the day, I like for people to take the long approach, right? Buy and hold, right? We buy and hold. When should we sell a stock? When we need the money, right? When should we buy a stock? When we have money available, right? That is the type of things that we need to start, programming our minds to just wrap around. Is like, hey, look, I don't need to sell this until, I actually need money. And there's some other things that we can do that we can talk about if you come see me personally.
Thank you, man, for being on the show. Marcus, giving us some information on investing basics. The basics of just getting started. Some of you guys think that you got to put $500 a month, $1,000 a month, or all my money going to bills. What am I going to do? You can start real small, okay? You can start at $20, $25, $100. Just $100, because you jack off $100 real easy. We're going out to eat. Stop doing that, okay? Invest in yourself, okay, and get to the next level. What is some information for the people who listen, and how can they get in contact with you and get a consultation?
Yeah, for sure. You can reach us by going on our site, johnsoncap.com, or you can shoot me an email at marcus@johnsoncap.com, or follow us on social media, Johnson Capital Planning.
Marcus, thank you for joining us on the show.
Thank you.
And we'll see you guys in the next video.
Yes.